Hi there. Welcome to IE Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcillo. I'm a client portfolio manager at IEGAM, and my guest today is Sébastien McMahon, who is our chief strategist, senior economist, and vice president asset allocation. Sébastien oversees our managed multi-asset suite of portfolios. Today, with him, we are discussing economics of lending and whether it can be achieved, and asset class opportunities within the current market conditions. Good afternoon, Sebastian.
Hello, Rose.
So, you are in the camp of this time, it will not be different either. So, you don't believe in a soft landing scenario. Why is that?
Well, it has a lot to do with the historical economic data that we'll look at. So historically, when you have tightening cycles from central banks, and even when it's more like today, like when it's concerted, it was fast. In 18 months, we had about a 5% plus of tightening in multiple regions of the world. In Europe, we went from negative rates to 4% rate right now. So when we've seen that in the past, it's been the exception and not the norm that the economy did not go into some sort of a landing or some sort of a recession. We're not in the camp that we're going to have a dire recession. We think that it's just normal that at some point, we have an economic contraction as the economy digests all of this. But the lags from monetary policy always long and variable, and we've seen through history that between the end of the tightening cycle and the moment where we know there's a recession or not, there's always this gap, like right now when investors and observers of the economy become optimistic that maybe this time is going to be different. But we think that the factors that supported economic exceptionalism in 2023, like the growth in the U.S. fiscal deficit and the drawdown in the excess savings of households, cannot last forever. Maybe some of that is already fading. So looking into 2024, we think it's natural, it's prudent to expect that there will be some sort of a landing. So the soft landing theory, I think it doesn't really hold a candle when you look at the history of economic data.
Good. So if a soft landing is at best an illusion, but would you say that market are being complacent right now, given very stretched valuations among a lot of asset classes?
Well, I think you need to look at specific markets. We think the Canadian stock market is not overvalued by any stretch, so there is no worry from us over there. Small caps remain attractively valued. Where we do see some maybe overvaluation is in the US. More specifically, the technology sector in the US. There's been lots of enthusiasm this year about the AI theme, what they call the Magnificent Seven, the Apple, Meta, Tesla, Nvidia of this world. When you look at this basket, this one had a performance year to date. Right now, we're talking about 50 to 60% year to date, following the craze about the ChatGPT and all of that. So there was this enthusiasm that pushed stocks higher. When you look at the rest of the market, it's not that expensive, but this is so heavy into the S&P 500 that we think it's good to be prudent about the valuation of U.S. equities. But just to draw a parallel, if someone says right now, I want to be invested deeply in the Magnificent Seven because I think AI is going to change the world, very likely that person will be right. It's just when will these firms reap the economic benefits from AI? Just the parallel bringing us to 1998, 1999. If someone told you, I think the internet's going to change the world, so I want to have a strong overweight on the NASDAQ, well, that person was completely right that the internet will be changing the world. But the NASDAQ had to go after that in a correction of 83% from top to bottom because the economic benefits from all of that are not reaped at once. So history suggests that being when you're going maybe in some sort of a landing, investing where valuations are lower and selling where valuations have become pricier is a good strategy.
It pays to be patient. So different segments of the market that you're looking at. I know you've spoken a lot about the opportunity in fixed income. Is all fixed income a good investment at this point? Anything that we should be careful about?
Well, I would be careful with the high yield bonds. If there is some sort of a lending, the weight of debt in some businesses could become too much. But if you look at sovereign bonds, if you look at good quality corps, if you look at long duration sovereign bonds, I think right now we have an opportunity that could be historical. The yields are at 20-year highs in multiple regions of the world, so you're getting a good yield for your money when you buy government bonds. And if we do go into some sort of a lending scenario, then you could have some capital gains too. So the moves in interest rates right now are to the upside, and there seems to be some momentum there. So it's hard to time the exact moment to invest in there. But I think likely when we do these podcasts in late 2024 and 2025, we'll be discussing how late 2023 was a very interesting and profitable time to invest in fixed income.
We're looking forward to it. Last questions for you. It's about your allocation in the equity market. I know you've spoken about a lot lately of some conversion trades. What is a conversion trades, and what exactly are you doing in portfolios?
Yeah, sure. Conversions trade allows you to be opportunistic, to be tactical, whatever the economic environment brings. And in this case here, we have two tactical trades, convergence trades that we're looking at and that we applied in the portfolios. First one is that when we look at the odds of a recession that seem to be priced into different asset classes, we find that for the S&P 500, the odds of a recession priced into the asset seems to be somewhere around 10 to 20%. And when we look at commodities, it seems to be somewhere between 60 to 80%. So being long commodities, short US stock market, it's an interesting trade because if there is a recession, likely the US stock market will do worse than commodities. So you'll gain on the trade. And if there's no recession, well, commodities should do better than the US stock market. So you also win on the trade. So this is one idea that we implemented. The other one will be, we discuss technology. We think that technology is pretty expensive right now. We think that energy is not. So if technology is expensive, you can short technology, being long energy, and just the sector rotation that usually comes when some sectors have dominated so strongly for a while, and then money usually flows somewhere else. We think that's another idea. So these two convergence tactical trades right now are implemented in the portfolios, and they've been doing quite well.
I really like that kind of insight because I think it puts in perspective that despite your expectation of an economic slowdown, you're not 100% cash. You're still fully invested in the market, and you're just being more discerning about how things are positioned within asset classes. And I think that gives a very good value for listeners.
Yeah, and the overall level of rates or yields that you can find in multiple asset classes right now, it's a very good environment for balanced strategies. So it's not about, you don't have to be precise on the timing of your exposure to equities or US equities just maybe like 10 years ago to do well. Right now there's lots of opportunities for yield, so a well diversified portfolio right now is a very clearly winning strategy.
Well, thank you so much for your time.
Sure, thank you.
Have a good afternoon.
You do.